All right, guys, if you're listening to this, then you're getting early notification of a price hike to our membership that is coming down the pipe. What that means is the price for our membership is going up. Now, all members are locked in for as long as their membership remains active. So if you subscribe today, you're going to get the lowest rate ever on a membership. Meaning, once the price hike happens, you will not be able to get the rate that you see here today. So lock your rate in now before the prices go up and join us on the inside. Another headline driven week in the markets where trade talks continue to dominate price action. Saw the market drift up slightly this week, but I think we're still obviously in the zone where we're running risk of this being a bear market rally rather than the start of another or a new bull market.
Yeah, as long as it remains bearish trend, I'm still pretty bearish on it. Take a look at XLU though. Like XLU has been holding up very well, and it's
Yeah.
neutral trend right now actually. So there is definitely some progress happening in the XLU realm. I wonder if we're gonna get a slowdown regime. It looks like it's
Let
possible.
let's actually talk about that. So coming up into the last week here, last 2 weeks, sorry, we've been seeing like growth impulses right here. We've been seeing them start to tick up. We're still so far from any type of like bullish growth impulse action, but we are getting to the point where maybe after tonight's refresh, we will be in slowdown territory, and that's like something I think a lot of people need to acknowledge, not necessarily as we're in the all clear, but more so that you're in an environment now where things may start to click together, like the defensives, XLU, for example. If healthcare can get bullish trend, possibly that. Even equities can try, breaking equities break or Nasdaq breaking above um 490 on the Qs. Maybe that has a little bit more potential to turn into something more than a bear market rally, which is what this is right now. We could turn into some possible bullish trending price action and then maybe starting a new upward trending market. But I think that the first step to all this is getting out of this negative risk off environment and getting into the slowdowns a very good early sign. And that's obviously a good sign for Bitcoin as well. I mean, this week Bitcoin has made some nice moves since last Sunday, right? So Bitcoin went from pretty much 85 to 95K in the last week. And we're now back above Momo, but we still have to consolidate a bit more up above Momo to really get momentum in the Bulls' favor and get that trend flipped. As of right now, it is somewhat seen as still like a bearish trend, possible bearish trend reversal risk here. So until that trend flips bullish, we're pretty cautious on Bitcoin, but it
Yeah.
has improved significantly over the last like 2 weeks.
I think this could also just be foreshadowing. Like Bitcoin always moves before risk assets. I wonder if this is foreshadowing a possible just reversion and coming out of this. And I could see that happening because what we're seeing right now is really reminding me of when we came out of 2022 and we longed the NASDAQ. Uh, and we actually got a lot of hate for that when that happened because everybody was so bullish. Like there was no bullish catalyst. How could you be long the NASDAQ at the moment? And this environment kind of reminds me of that. Like we are at the precipice of completely cutting ties with China and a huge shift happening in the market. No one wants to risk their money. And yet we are seeing the growth index ticking up behind the scenes. So it really reminds me of 2022 and coming out of 2022 into 2023. And I wonder if that's possible. And maybe that's what Bitcoin is kind of telling us right now.
Possible. I think that the biggest underlying signal here is going to be getting back into an actual risk on regime, right? That's the line in the sand that has to be defended at all costs. Like if we don't get into risk on, I think the best the market's going to be able to show us, like in terms of outperformance, is going to be in defensive plays like the utilities, healthcare, and possibly Bitcoin. But for us to get that, you know, leveraged T triple Q long and strong bull market, I think, we're going to need that risk on environment expansion or inflation and growth strength has a lot of repairing to do here. I mean, this is just a good uptick, but a lot of work still needs to get done here to get us back into that bullish trend for growth impulses and push us into positive strength territory. And until we're above that zero line on strength for growth impulses, I think the base case has to be defensive. And at worst, obviously, we fall back out of slowdown and then we go into risk off again. So let's talk about bonds because these also are showing some interesting signs of bottoming here. What seem to be a bottom, but I think that the issue here with bonds is there seems to be some sort of viability trade still underway. Like when we look at the dollar, right? The dollar is at 99. Not even we're having a tough time getting back above 100, and I think that if weakness like this in the dollar continues, it's really just acting as a signal right now that um, nobody wants. There's an underlying there's underlying fear on U.S. denominated assets, like dollar denominated assets, and until there's like some relief on the dollar weakness, I think TLT will have what we have been acknowledging as this weighted vest. And another thing that I think is adding to that weighted vest is the um, the inflation swaps. So the twos and tens inflation swap spread is basically still in the nearly negative 50 basis points, implying that the 2-year inflation swap is 50 basis points above the 10-year inflation swap. And historically, going back to 2008, bonds do not have the same upside momentum when this spread is falling, or at least falling towards negative territory, or actually in negative territory. Bonds start to have this weighted vest. Now, if this spread or swap spread reverses and rips higher, I think that will take the weighted vest right off of bonds. But until that happens, and we see this chop here where the swap spread just doesn't really reignite higher, that's going to act as that weighted vest where you get these rallies like for example on Wednesday, nice rip up open and just bleed all day. And that's like that weighted vest price action where I think that um that's not going to resolve until we get some sort of resolution on the dollar or inflation expectations.
Yeah. Well, how does that affect gold in your opinion? If those spreads move higher, is that going to cause a reversion in gold and have that capital flow to bonds from gold?
I think there's the potential for that. So look, this is not see these aren't binary signals, right? So just because the spread is negative doesn't necessarily mean bonds can't do well. For example, we're at negative 50 basis points. If we rise from negative 50 basis points here to zero, I would assume bonds do well, even though you have not gone to positive territory. It's more of the rate of or the directional change in where the spreads are going, right? So just because the spreads are negative doesn't necessarily mean that bonds can't do well in the future. It just means that if they continue to be in this negative territory and just not accelerate higher or shift higher, then bonds likely will continue to have that weighted vest price action. So in an environment where the spreads don't really like show some type of relief higher, I think gold will outperform bonds. Now, the way that this spread has shown its relief function is very drastic. Like if we go back to 2021, right, when bonds did absolutely terrible, and this kind of bottomed out around 150 basis points, 160 basis points, and then just within a matter of, I'd say like 4 or 5 months, it goes all the way back up to zero. And this type of move, if we can go up to zero and accelerate higher, that's where you want to be long bonds when the spreads go the other way, when they basically collapse, right? The other way, or I should say they rip. When they collapse into negative territory, it's a sign that inflation is an issue and inflation expectations are weighing on the curve. So I think that as long as we're in this position, it's going to be tough for bonds. It's not impossible. Like I said, if we get that rip up higher, all it takes is, again, one headline to really shake things up in this market, right? And then swap spreads start accelerating higher, and I think then bonds will act accordingly.
Yeah. Well, at this point where we're at right now in the economy, If we do get a recession, is that even going to be deflationary at this point? Or is that just going to expand the deficit to the point where a recession is actually going to be inflationary?
Well, I think that the key determining factor here is, can we get a recession?
Well, yeah, that's the big question. I think
No, well,
like
I was, well, yeah, I was,
if we do get a recession, like I think everyone's just gonna crawl back to the dollar. Like, yeah,
yeah,
everyone's
well,
selling the dollar now, but when America goes into a recession, everyone's gonna get hit harder than America, and everyone's gonna flock to the dollar. That's how it always works, and I don't think that's gonna change.
yeah, like I think the most important part to what you just said, or what I was continuing on, was like, do we get a recession with a 6% deficit and growth where it's at? Like, are we going to significantly slow? Remember, we have to bring the output gap from plus 2% to zero and then into negative territory. The damage that's been done, mostly import driven at the moment, right? There's some hit to consumption. There's a lot of uncertainty. But if it doesn't persist, right? If it doesn't persist and there's some like relief, even just some type of a shallow hit. Think of like a shallow hit and then some relief, and that output cap can't fall to negative territory, and you really can't get that sustained those sustained levels of negative GDP prints. Then there's no recession, and likely what ends up happening is equities start running higher on the outlook that the deficit's going to just remain unchanged, right? Because if the deficit remains unchanged and you don't have a recession, like, that's basically what this run from 22 to 23 to 25 looked like. 23 to late 24 on the markets look like. That's what that was. The deficit outweighed the recessionary pressures from 22 from the rate hiking cycle. So the Fed basically had to catch up with fiscal, which they did. They did their job. They caught up to fiscal, and they ended up holding rates pretty steady. I'll buy a couple rate cuts, but like they didn't actually pancake the curve. And I think that therefore the Fed's in a position where, like, if you don't get a recession, expect minimal rate cuts. Like, so you're not going to face a universal path here where the Fed's going to just blindly keep cutting rates. Like, you're not in a situation right now with fiscal where it is that the Fed is going to just be on some like 25 basis point cut per meeting cycle where they just bring rates all the way down to 2018 levels, because they have to offset the deficit. And I think that's the big elephant in the room. You know, if if you can strike a recession with a 6% deficit, well, okay, that's interesting. And then if you do that, what happens to the deficit thereafter? Is it again, you're running a positive, you're running excess in the economy as it is. So you have to destroy the excess and then actually you have to eat into the potential, right? Because you're outputting above the market, the economy's potential right now. So you have to clear the excess output, and then you have to actually eat into the economy. And if that's possible, given the current environment, then I think that you run into the situation where a real recession is probably not good for bonds. You might have a short term positive shock where bonds go, think TLT going 90 to 100, 90 to 105, 110. And then what ends up happening is everyone realizes, well, okay, they're really just going to blow the deficit out at that point, and it's going to get smacked the other way. So
Mm.
I think initially you have this situation where employment gets craters, right? Or unemployment skyrockets. The Fed's panicking. Everyone's like, okay, here we go, cutting cycle. Everyone jumps on the bag. When the forward curve falls like a pancake, everyone's like, okay, time to cut. You're seeing the front end fall to, the back end fall. 30-year Treasury. You could look at it, what it did last summer. Whoops. So look at what it did last summer. We went all the way down to 3%. Maybe we get down to 3.9%. Maybe we get down to like 3.9, 3.75, even 3.5. But I don't think that's going to be a trending environment for rates. given the level of fiscal where we are right now. I think what's going to happen is you get that move where, essentially what I'm implying here is if you get a recession, you can't be of the mindset that, oh, the deficit's going to hurt bonds, so we can't long bonds. We have to just ignore bonds, because I think bonds can give you the opportunity to make some money on them. But it's not going to be like this cycle where if you go back to 2018, right? You had this move up, this gradual move up, and then they kind of just chopped sideways, and then COVID came, and they ramped up into COVID, right? It's not going to be something like this. You're not going to get that two-legged move. You're going to have something that's more, think of like the summer of last year, except you have that that follow through with unemployment, and bonds get up to like 100, 105, 110. But give them a couple months, maybe a quarter or two, and then everyone's like, okay, well, now the deficit, what happens there? And then that gets whacked. Bonds get
Yeah.
whacked in that
Like
scenario.
like the Fed is probably going to cut initially as they see unemployment rising, but there's going to be a level where cuts don't really fix the problem anymore.
Well, if you look at it like this, right? So the Fed's objective, right, has to be to counteract fiscal. Otherwise, you're going to just get inflation, right? The Fed has to say at some point, look, if the government is running a 6% deficit, how can we balance the government? How can we, if we can do anything, what can we do to kind of inspire fiscal stability? Well, it's going to be to, make net interest expenses or interest expenses on the debt or interest expenses in general, the top three expense category on the budget, right? And that's what it is now. So the Fed is able to manipulate that cost, which is why I think the administration is very vocal about this, because they know that that's the one cost that the administration can't physically address. Like the administration could cut healthcare if they wanted to. They can cut Social Security if they, not that if they wanted to, but these are things that could be done. You can't cut interest expense. You can't without defaulting. So it's one of the only expenses that their hands are truly tied behind their back. And I think that, from the perspective of the Fed saying, okay, how do we dampen inflation effects? We have to hold rates up higher for long. We have to basically put pressure on the government for their path of fiscal, right? So, okay, what does that mean? Well, that means that if the average interest rate on government debt's about 3.5%, right? Average interest rate, the Fed can't necessarily go below 3.5% for a prolonged period of time. Because what's going to happen is if they go below 3.5% for a prolonged period of time, they're going to stop that pressure of interest expense. It's going to be there, but it'll slow down, right? And if there is such thing as the Fed dampening inflation effects, then they have to basically keep the pressure up, meaning that yield actually has to keep rising to put pressure on not the administration themselves, but put pressure on the spending issue. If the chairman of the Fed is saying that the United States is on an unsustainable fiscal path, then to cure that, they have to continue to add pressure. And to do that, it means that they can't bring rates below the average rate that, they can't provide an opportunity for the government to start cutting interest expenses on a budget that's, on a deficit that's 6%. They have to bring in spending cuts. That's what has to happen. And I think that in a situation that we're seeing right now, the government has to at some point acknowledge that interest expenses can only go down so far before inflation becomes an actual issue, like a 2022 issue again, where inflation starts going up and continues to trend up, and it doesn't go down. It won't stop. It won't be as transitory as it was in the last run.
Yeah.
And that's why term premium, I think, is going up, because people are seeing the way the dollar's reacting. Dollar's falling, right? People are like, okay, there's a test to U.S. exceptionalism. Okay, we have to be concerned about this. That's fine. I understand. Listen, the way the administration is acting and the headline warfare that's going on right now, it's going to cause a lot of uncertainty and a lot of unrest, and that makes sense. The way the dollar's moving. But the issue here is that you have the government not, or at least the administration not, or supplying enough progress for the deficit issue, which we were told, originally we were told Doge was going to cut 2 trillion, 1 trillion. Now they're talking about 150 billion. Okay. So things have fallen down there. And then on top of it, we were told that the tariff revenue is going to be immense, but like we're the tariffs are changing so quickly, and exceptions are being made at such a high rate that no one can actually figure out where we're going to be in a year from now, right? So like
Yeah, it's
the only
impossible
the
to
only
like make a
yeah.
plan. And like we haven't even seen a single deal. Like what happens if the first deal comes in and it's just shit? Like it's just a bad deal. And then
Oh,
that
that would be
sets the
terrible.
precedent for the rest of the deals. Like, oh fuck, this is actually not going to fix the deficit issue at all.
That's possible. And I think that the issue with so look, the deficit issue is this. Like the way the administration, I think, based on their approach this is we'll try and cap as much spending as possible, use tariff revenue to bring in use tariffs to bring in some revenue to try and offset the tax cuts with some other spending cuts, right? The loss of revenue from the tax cuts. Use the tax cuts to grow GDP, right? So if you can kind of dampen the spending portion and boost the growth portion, if you can get growth running up faster than your deficit rate, right? You're not if you can get growth to accelerate faster than the deficit's eating away or the deficit run rate, then you can basically grow out of the deficit over time. But the problem is that the proposed solutions or the proposed strategy continues to take hits from many corners as like, again, the tariff plans are changing constantly. The tax cuts are not the idea of cutting tax cuts are not changing, but the revenue and the spending cuts to offset the loss of revenue is being pushed left and right. Or no one knows where that's going, right? So these are all big uncertainties around the deficit, and I think that given that the economy is running in a surplus right now in terms of above a state of being above potential, you can bring down growth without necessarily causing a recession. And in that scenario, if you can close that output gap, you open up the door for the Fed to reduce rates a bit without like we were saying earlier, down to maybe, Fed drops rates to a position where them 3.5%, right? Let's just say in that scenario, they can bring rates down 100 basis points, roughly. And in that scenario, the economy isn't necessarily cratering, and neither is it really running at such a high run rate as it has been. But you're in a position now where you're much closer to a recession than you are when you're 2% over potential. You're down to zero, right? And in negative territory, recession risk really does start to accelerate. And I think that that's the environment that the administration is trying to get the economy to get lower interest rates, right? And the only way they can do that while running a deficit is create maximum uncertainty. Like, think about it. How is the government going to warrant an environment of lower rates at a 6% deficit? Like, how do you do it? You have to just like try and create some sort of chaotic event that hurts growth enough, but doesn't. Obviously, again, there's only so much you could do before. Like, I think that the situation with the administration at hand right now is like, look, they have these tariffs in place, okay, but these tariffs are so uncertain, okay, and if they just run rampant with the tariffs, like 50% tariffs across the board indefinitely, I think that causes more than a recession. I think that's like there's not the stair stepper. You don't just go from over hot to mid to cool to recession. Like these tariff levels, like from 10 to 50%, like anything beyond 10%, I think already like you're in the recession territory, right? And then into 50, 60, 70%, like there's no slowing the economy. You're just basically breaking the economy all at once. And that's why the market's been the way that it's been, because like the initial tariffs from the poster board, when that came out, they were obscene, and the market really choked on that and fell hard. But obviously there's been a lot of walk back. There's been a lot of like positive rumors and maximum confusion. And I think that what this is doing at the core is destroying sentiment. not necessarily destroying growth yet, but it's destroying the optimism for future growth, which likely yields to slower investments, more caution, and can slow growth. But at the end of the day, I don't think the tariffs can stay at these levels in perpetuity because you're actually going to get a recession if you do that. So it's kind of like a way to trick the market into thinking that the deficit can be overridden by extreme trade policy. Get get some environment of lower rates. Try and take advantage of that, or slow the rise of net of interest expenses on the deficit, and then in the process throw tax cuts in there, try and stimulate the market, and try and get growth going while capping spending cuts. This is like what the administration seems to be portraying when I read and see these headlines and look at what's going on in the media. Anyways, if you have any questions, feel free to reach out to us on our X at the Market Radar or go to our website at market-radar.com.